Hello, everyone. This is a session to talk about balance sheet ratios. First and foremost, this is what a balance sheet looks like. On the left-hand side, most accounting people list all the assets of your company, and on the right-hand side, you'll see liabilities, both current and long-term, and then you'll see the equity section. And the equity section is the section that talks about the money that the company owes the owner. As you can see, typically it discusses common stock, and retained earnings is a fancy word for net profits. And the current means the current year, and prior means all the other years that you've been in business. On the asset side, you're going to see it broken out generally in current assets and total fixed assets. And obviously at the bottom, we add both sections of assets to come to a total. And then we go back to the right-hand side and we add all of the liabilities plus the equity. And as you can see, the dollar amount should always equal, and that's where the name comes from, balance sheet. Now, generally, most business people never look at a balance sheet. And the reason for that is it gets a little confusing. We all tend to look at our profit and loss statement every month, but rarely do we spend time looking at the balance sheet. And yet, if you ever go to a bank to borrow money, the banker is going to be more interested in the balance sheet than he is your income statement. So let's have a look at some of the ratios that a banker or any lending institution would look at as they analyze the balance sheet.